Hiya, I'm Elliot from Free Life Financial, and today I'm going to explain life insurance in a way that's super simple and easy to understand. Life insurance is an insurance policy that you can take out to protect your loved ones in the event of your death. If you take out a life insurance policy, you will pay an amount either every month or every year for that policy, and that is called your premium. If you were to pass away within the term of your policy, your loved ones could receive a specified lump sum, and this is called the sum assured. When you set up the insurance, you'll also choose how long you want the insurance policy to last, and this is called the policy term. So let's look at an example. You take out a life insurance policy over 30 years with a £100,000 sum assured, and the premium is £10 per month. That means you pay £10 per month, and within that 30 years, if you pass away, then your loved ones could receive a lump sum of £100,000. Now, it's very important to understand that if you do not pass away within that 30 years, you won't get any money, your family won't get any money, the insurance will stop. Now, there are two main types of life insurance: level term and decreasing term. Level term means that the sum assured remains the same for the whole term of the policy. So if you were to pass away in the first year, your loved ones could receive 100 grand. If you passed away in year 29, your loved ones could still receive the same £100,000. That amount doesn't change. It stays level. However, do remember that if you passed away after 31 years, when the policy has already stopped, your family would be unable to claim. The other type of life insurance is decreasing term, and with this one, the sum assured does not stay the same over the term of the policy, it decreases. Often a decreasing term insurance will be taken alongside a mortgage. So if you have a 30-year repayment mortgage, your mortgage balance is decreasing over a 30-year term, and your insurance sum assured would also decrease over the 30-year term. So if you had the £100,000 decreasing insurance and you were to pass away in the first year, your family could receive, for example, the whole £100,000. But if you were to pass away after 25 years, when there are only 5 years left on the policy and only 5 years left on your mortgage, it might only pay out £15,000. These are just made up examples. The real figures for a decreasing term plan would depend on a few variables, including how the policy was set up when you took it out. Usually, a decreasing term plan will be set up so that it's always enough to cover your mortgage balance, so that if you were to pass away, whatever was left on your mortgage, the sum assured would be enough to cover that amount, so your loved ones could receive enough money to repay the mortgage in full. So, as you can probably guess, a level term plan would generally have a higher premium than a decreasing term plan. Finally, it's worth noting that these are sometimes referred to as level term assurance, decreasing term assurance. What we're talking about is still life insurance. Of course, the idea of this video is to give a really basic explanation of how it works, but there is more to it. So if you would like some more info, please get in touch.